Good morning, everybody. We're going to get started here in about 1 minute or so. So just hang tight, please. All right, let's get started. Good morning, everybody. It's 1 minute past the top of the hour here for Tuesday. It is the 8th of October. Hope you guys are doing well, and welcome to again our new morning show here on YouTube Live. If you are new to this, please make sure you subscribe to the channel. Please always like this. It allows us to keep it going, because as I always like to say, if we don't get the algos picking up the show, we're gonna have to stop doing it because it won't be worth it. So the more you can spread the word and subscribe to the channel and like it, thumbs up, that would really help us. And of course, feedback, right? Let us know what we can help you go over more. The point of the morning show is simply, a couple things we're looking at, one or two things at most, kind of thing, 10, 15 minutes at most. And I think that's, again, what distinguishes this show from many others, where, we look at some of the morning shows where people are just, yapping and babbling on for an hour, and it's just useless. So you want to just do a quick 10 minutes, a quick heads up. If you are an Inner Circle member, you of course know that in 20 minutes from now, so at 9:20 New York time, we are going to be doing our live Tuesday member session. We're going to do a live gap trade and look at some other actionable stuff, including reviewing a trade we did yesterday and some new stuff we're looking at. But for today, for right now here, for the next 10 minutes or so, I want to bring up one really important thought. And this is something that I with our my morning chat with my colleague JB, I mentioned to him that I discussed it with one of my old good friends who runs a family office. And we were talking about this morning. I was on the treadmill, and he was... I don't even know what he was doing. And he made me on the gym as well. We were talking about this, and it really comes down to one very simple thought that I think is right now something we should ask ourselves. When I look around and I ask people how they are currently looking at the markets through the lens of the rest of the year, the remainder of the year, right? It's really just the fourth quarter now. I cannot find a single person outside of a couple of shops that tend to flip-flop pretty quickly, that is not very constructive, the market. And me too, I am constructive, right? However, if we want to truly be risk managers and not just be constantly bullish on stuff, because at some point that blows things up, we do need to be able to respect the other side and at least see this. And again, I'm going to preface this by saying I'm bullish because as we've been talking about here now for the past few weeks, and if you're an Inner Circle member, you know that this has been our base case now for some time. If you look at the liquidity coming back into the market, again, this is the global liquidity measure. It's very clear that there is a an uptick in liquidity, right? And so that's bullish. I don't want to be bearish in that. However, and again, this is a risk management exercise. So this is something I think for people to just kind of think about this. Like if all we are doing is looking at chart breakouts, we're not risk managing. That's not risk management. That is chart chasing, right? And it works until it doesn't. So what I'm trying to do here for the next few minutes here is just trying to make sure that everyone asks themselves this question, and ask yourself this question for the next 24 hours. Really, I really mean this. This is a serious exercise. Ask yourself, what if there is no rally in the fourth quarter? How are you positioned? Again, my base case is my base case still is that there should be a rally, but I'm extremely flexible to say, you know what? No, it's not working. Because there's a few scenarios that we could see play out where it just doesn't happen. And I'm going to walk you through those right now, particularly one of them. Okay? So, first of all, the question we have to ask ourselves is how much of this new global liquidity injection, and particularly as it relates to U.S. equities. I mean, in China is different. I don't want to, not be long China, not from a day trading perspective, but like sort of multi-quarter, multi-month. So that's one thing. But what about U.S. equities? So U.S. equities are currently trading at a trailing PE of, multiple of 27 times earnings. Next year's PE is about 21. That's pretty steep. It's not crazy expensive, but it's pretty steep. And we're looking at earnings to grow 10, 15%. We've got some analysts that are way above that, 20% for the broader S&P, right? And so we have to ask ourselves, given the fact that the market is forward-looking, and this is important, so I'm going to get to a chart right now that I think is going to resonate with everyone, right? Because we still have this seasonal tendency. This is not the chart. This is just the one that everyone knows. The seasonal tendencies for some weakness here in October, in the first part of October, and then they basically rally into the rest of the year. It's still my base case, but I want to be very open-minded to what if this doesn't play out, okay? And so, again, I would really encourage you to think about what does this do to your portfolio? What does it do to your mentality of chasing chart breakouts if that's what you do? And I know most people do, right? Are you still going to be able to make money? And the answer for most people is definite no. All right, so we want to make sure we're open-minded. This is an exercise here today about being open-minded, right? So let's look at what's going on in the S&P. And what I'm going to do is I'm going to just bring up a monthly chart. And I hope this is helpful. If this is not helpful, please let me know. If this is helpful, please let me know as well, because I'm trying to test, how, to what extent people are looking at this market for more than just, again, basically chasing it higher. So S&P 500 monthly chart for the month of September. So in the month of September, the S&P was up 2%. In the month of August, it was up 2.3%. In the month of July, it was up 1%. In the month of June, it was up 3.5%, right? But what's most interesting to me is the fact that we were up that much in the month of September, right? Now, what I can tell you for sure is that this global liquidity injection, particularly the Fed, and to some extent China, some people saw the China thing coming as well. So the global liquidity injection was probably front ran. The market is a forward-looking mechanism. I don't know if you guys have heard that before. I talk about this a lot to our members and our clients. The market looks forward. So the market looks forward at least 6 months, sometimes more. Sometimes only 3 months if there's like some really uncertain periods, like right now, that's arguably where it is. But 3 to 6 months is kind of like the base case. So if that's the case, if the market has been forward-looking and it saw this liquidity injection coming, is the month of September already reflecting maybe some of it what should now be baked in for the next few months? Again, I'm not saying it is. We will only find out in hindsight. But I'll give you a trigger point that would certainly change my mind in a second. But that's something I think we need to be open-minded to. The market is a forward-looking mechanism. And so I ask yourself again, if all you're doing, and I don't mean this in sort of a negative sense, but if what you are doing is basically just hoping for the market to go higher all the time and chase chart breakouts and you're long in your long-term portfolio anyway, that there's no risk management embedded in that. Right? That's just all you're doing is riding a bull market. And that's good. And that's one of the greatest ways to make money. The problem is when that stops. Right? And so again, I want to reiterate, I'm still bullish for the fourth quarter. However, I'm extremely open-minded to flip that in a heartbeat. And there's two things that would make me flip. First of all, And again, you guys know why we don't do politics here, because that's not the point. The point of this show and everything we do at the Steady Trader, Blue Oak Advisors, which is the company that runs the Steady Trader, we're really about the markets. How can we make money in the markets? But I'll throw this out. What if we have some whatever unclarity, or people are not happy, right, about the outcome of whatever happens after whoever wins this election, right? And then more importantly, what if at the margin some of the policies that are being suggested from whoever, right? There's out there policies on either end from a posturing perspective. That's pretty normal. If you have to run for president, you're going to throw some things out there that are quite borderline or even on either direction. What if some of those things could possibly be actually implemented, right? And we could go quite deep into this. I actually ended up reading the summaries of some of the deeper policies on both sides, so I'm aware, right? Both sides for both the Trump campaign and the Harris campaign. And some of those things could actually pass. Remember, we're probably going to have a split government either way, at least initially. That's the point. So you could have a situation where that could cause a problem for the market. But then I think even more importantly, and this is really where I'm getting at, to be more importantly would be if the S&P 500 is quote unquote still trading within sort of the range of, and let me give you this on the weekly chart. Let me get rid of this. Is still trading between roughly, let's say 5,800 and 5,400. By the time we get to the November or December rate cut, if there is one, I think then we have a problem. Because if the market couldn't rally further upon more stimulus, by then I really think it's over. I think then we're probably going to also start to see other things kind of snowball, and that would make me basically go bearish, right? So there's those two catalysts. We have, and this is tricky. This is not something that we can come up on the spot with. We have to kind of map out something right now to kind of see what are we looking for, right? And so this is where, again, it helps. And I say this, I know it triggers some people, but don't just look at your NVIDIA chart. Like, there's more to it than that. That is a dangerous way to look at the markets. That is okay from a trading perspective if you have one position on NVIDIA, but that is not the market, right? Like, there's so many other things that are going to happen over here that you won't see if you're just looking at the ball over here. So anyway, that's that. So the question is it priced in or not? We shall see, but I'm really starting to think that it might be priced in, right? So that's of concern, and so I just wanted to kind of put this out there. Let's see here. Keith is saying that he shout out to the TSD Trender, which is our momentum indicator. He got a signal on Ross Stores, ROST. He bought puts, made 22% on a trade. Well done. Well done, Keith. Yeah, I'd love to hear more of that if you guys have anything to share like that. The last thing I'll quickly mention, and this is interesting because it really goes into the same line. I'll type this in here. I'll show it to you on this here. This is the bond market volatility. And I don't know how many of you guys watched this morning show the other day. This was Wednesday or Thursday, I can't remember. And we talked about this very sharp increase in the MOVE index. And you can see how it actually led to a big move in the bond market, right? The bond market essentially collapsed, bond yields shooting higher. And this happened with the MOVE index having made that rally before. Right, the MOVE index, which we talked about here in this show, was I think it was mid last week, something like that. We talked about the MOVE index having that big rally, and then of course it spiked even higher yesterday, right? So this is the stuff I'm watching too. The MOVE index, we're at a point right now where the MOVE index is going to run into some resistance. But again, that's the kind of stuff we're watching, because if this doesn't calm down and bond yields continue to go higher, right? Then we have this stagflation environment, and that could be another thing that at least I certainly want to keep a close eye on, because again, as much as our base case remains, I don't want anyone to leave here right now in the next minute and say Serge is bearish. I'm not. Serge is always bearish. I'm not. I'm 90% long in my net worth, right? I usually am, but I will reserve the right from a trading perspective to very quickly be open-minded, number one, and number two, say, hey, maybe this fourth quarter rally won't happen, right? So again, we'll see. I just want to throw this out there again. Hope this was helpful. If you are an Inner Circle member, we are going to see you over there in in exactly 5 minutes. So make sure you join over there. We're going to do a live gap trade. Markets this morning are gapping higher, so there might be a gap trade in the S&P. And we're going to look at some energy ideas as well. We just closed yesterday our ExxonMobil trade, nicely profitable. So if you're an Inner Circle member, I'll see you guys over there in now less than 5 minutes. Have a great start to the day. And if you have any questions, comments, again, please give us a thumbs up. And please subscribe. Again, it just helps us keep this alive. Otherwise, we unfortunately at some point will have to shut it down. Thanks so much for joining, and have a great day.